Welcome to your Mortgage Insider update for this week of August the 5th. Well, a lot of headlines this last week. Started with the Bank of England actually cutting their interest rate 0.25% in advance of the Fed meeting. Our Federal Reserve decided to hold rates steady, and they're not quite convinced. They are starting to feel more confident that the economy is not taking off in inflation, and inflation is now being tamed. But a key report on Friday for U.S. jobs and unemployment going up to 4.3%. This was expected to stay at 4.1%, and this increase triggers the SOM rule. SOM rule is an economic event that's looking back into history. Each time the economy has gotten to a point of the lowest rate of unemployment, this last time it was at 3.6%, when unemployment goes 0.5% back up above the lowest point in unemployment, the SOM rule typically indicates a coming recession. There's been a lot of indicators like this, the inverted yield curve. We can take a look at some of the big items, but as we look at the charts today, just keep in mind that worldwide stock markets are falling. In Japan, the stock market fell significantly over the weekend. Coming into today, our stock market started off a little bit lower and has since paired some losses, but it's not looking good for the worldwide economy, and the projection is that interest rates are going to come down in the future. The good thing with mortgages to keep in mind is that mortgage rates tend to lead the actual drop of the interest rates from the Federal Reserve. So if the bet is in that the Federal Reserve will lower interest rates, we're seeing those lower interest rates today. Let's check it out. For those who don't track the U.S. interest rate market constantly and you trust on videos like this, 3.779%, below 3.8%, has not been seen since the end of 2023. We've had highs and we've had lows over the 10-year Treasury. We're specifically looking at this because it gives us a broad economic outlook on the direction of rates over the past, and it gives us some insight into what we might see in the future. So we're going to keep things simple and look at the 10-year Treasury chart today. So as we can see, December 27th, 2023 was the last time we were at 3.79% on the 10-year, and for all of 2024, up until Friday, and now specifically today on Monday, the 5th of August, we have been above this level. So we've seen interest rates just on the climb. Simply here, the blue line is the 200-day average. So it gives us the sense that we have seen interest rates climbing pretty much all year until this last couple weeks, where we started to the result of some ups and downs in the market, and now significant drop in interest. So we can see on Friday after that U.S. jobs report, the bet was in that interest rates are going to be cut in the near future, and we see some follow through with here. Just like we see in this chart in the past, we see lows and then highs and then lows. So rarely does this ever go in a straight line. Of course, we did see a pretty straight line from October 2023, but that was really a high that we had not seen in so long. The pressure actually coming into 2024 was that the Fed would start to cut rates. You maybe remember this. It was going to be March, and then it's going to be June, and then it's going to be July. Now it looks like it's going to be September. So as the year started out, the projection was, especially in December 2023, that we could have seen the Fed cut rates in March. And, obviously we got to March and that didn't happen. So interest rates drew higher. So as we approach the beginning of the school year, the last half of the year, where typically real estate volumes have traditionally been lower, we might get the fuel with lower interest rates to really drive the possibility of folks that need to make a move with their current home, have been holding off because of high interest rates. We're likely to see in the coming months a significant shift in the interest rate sentiment, and that sentiment is what's going to drive the market. So if you have any interest in looking to sell your house or consolidate debt, the time to do it is finally going to come around to where it makes sense to be able to downsize or upsize and not have to balloon your mortgage payments so much. Interest rates are not going to be back down at 3% anytime soon. If we could get interest rates below 6% in the coming year end or early next year, that would really fuel what is traditionally a slower time of year in the winter. Once we get past the fall, there's obviously an election coming that has a lot of people concerned. But as that starts to release the pent-up demand, I think the lower interest rates will really give that opportunity for folks to make their move if that's what they're looking to do. Have yourself a great week and a great end of summer.